Hello, and welcome to the virtual Frostbike seminar series. We were definitely bummed to not have Frostbike in Minnesota this year as planned, but we are making the most of it, making the most of our preparation and providing today's presentation to you in a virtual format. My name is Mike Barnidge. I am the Vice President of Finance here at QBP. I've been at QBP for 16 years in a few different areas of the business, including sales, our owned brands, and of course, the accounting and finance team. In my role, I am responsible for the management of the accounting team, credit team, and the financial planning and analysis team. That means that I'm involved in nearly every decision at QBP. And what I love about this role is the ability to understand the numbers, the story on how we achieved those numbers, and of course, the strategic nature of running the business to produce our desired outcome. In addition, the experiences we have throughout the year provide us an opportunity to learn about our business. But of course, we need to have that strong foundation of understanding in order to access those learnings that helps us impact financial outcomes. So today's presentation is really in support of building that foundation from a financial perspective. The purpose of this presentation is to build your awareness, your understanding, and your knowledge of the various components of financial management. I hope that you take something away from today's presentation that gets you thinking about your business at a deeper level. Similar to building a house, we need a really strong foundation, but maybe not so similar to building a house. We are always building out that foundation with the additional knowledge that we access, especially when we think about financial management. So for some of you today will be a review. For others, an introduction to a whole new world that you don't know, or maybe you've tried to expertly avoid over the years. We're going to review the income statement, the balance sheet, and common ratios to help to become more familiar with. We will talk about this at the end, but much of what I'm discussing is included in the recent cost of doing business survey that the National Bicycle Dealers Association put out. At times, it feels like I'm referring to this quite a bit, and then maybe I'm getting a kickback for doing this, but I assure you I am not. I really believe that the insights in the report, along with your own results, provide great benchmarks for you to be able to assess your business from a financial perspective. Your results, of course, may vary. So I want to make sure that you don't get caught up in any of the numbers that we represent, but do caught up in the conversation of understanding what you would need to achieve or what you would need to change in order to achieve some of the results that are listed in the presentation. Our agenda for today is to introduce the key components of the income statement, the key components of the balance sheet, and a few common ratios that you should be aware of. But let's start with the why. I think the why is always incredibly important to understand in anything that we do. So why do financial statements matter? Why should I care about this? First and foremost, it is incredibly important to know your business at the deepest level. How do we produce results? What are the key investing components? How much financing power do we need? What are the strengths? What are the weaknesses? You want to make sure you understand this, and you want to make sure that your numbers have integrity, because that helps you understand when to say yes, when to say no, or where you can do better as a business. Knowing your business inside and out is one of your most important assets. Next up, I think, is about leadership. And the question is, how do you lead a team of people without an understanding of how hard they need to work, how fast they need to run, or what deal you're asking them to make? This is about empowerment. You are the leader. You set the tone. So financial awareness helps you direct your team in a way that is incredibly beneficial for your results as a leader. Third, at some point, someone will ask you for your financial statements and ask you what you know about them. Maybe this will be your bank, maybe it's your business partner, potentially a supplier, or the individual that you hope to sell your business to someday. Your knowledge in this area is an asset. And that asset needs to be healthy and requires consistent work in order to deliver the most return as you approach these relationships. And finally, getting the most out of your business, your employees, and your business partners requires your confidence. They all want to know that you are going in the right direction, and the confidence that you have in understanding your financial reality is a major component to your success. Before I jump into the income statement, I want to talk about some key components for you to be aware of in your review. I'm going to be presenting from an example financial set to help guide you a bit. These numbers are not from any specific business, they are just examples. The income statement and the balance sheet have both numbers and percentages. At least they should for you. We use percentages as tools to be able to help compare two different periods or years. This is known as common sizing. You may be most familiar with this from the margin side of the conversation, as we often talk about margin in terms of a percentage. Common sizing on the income statement ties each component back to revenue. Think about margin as a percentage of revenue or net income as a percentage of revenue, and so on. The percentage allows commonality and analysis between two different periods, whether that's 2 different months, 2 different quarters, or potentially 2 different years. It is important to understand the reason for the variance in percentages that you are seeing year over year. But it's also important to look at the actual dollars that are in play. It is, of course, possible to spend more as a dollar, but it shows a reduction as a percentage. Total payroll is a great example in this view. We spent more on payroll in 2024 versus 2023, but as a percentage, that shows as being 16.8% versus 16.96% because our revenue is higher. This relationship is common throughout your statements and the foundation for a consistent review. Okay, so let's move into our first financial statement, which is the income statement. At the highest level, the income statement, or the P&L, which stands for profit and loss, shows how much profit or net income a company makes over a given period of time. That time may be a month, it might be a quarter, or potentially a year. I like to think of the income statement as a key indicator or a key test of the viability of the business and the business model, along with the financial structure we have created with the business. It should deliver a very simple yes or no answer to the question, are we making money? So let's start by reviewing the income statement at the top. When you hear people refer to top line, they are often referring to something that is quite basic in concept, revenue. Top line revenue, the very first line on this document. So the basic calculation of the income statement is revenue less cost of goods sold equals our gross margin, and then gross margin less our total expenses and other income equals our net income. Revenue is made up of the results of what we are selling, less discounts and any returns that we may have. Our cost of goods sold, often referred to as COGS, are the direct product costs or cost of the services to produce our revenue. And then gross margin is the net of sales less COGS. I like to think about gross margin as setting the table for profitability. We're going to be very hard pressed to achieve high net income if our gross margin is not high enough to overcome our expenses. So it is my first break-even test. What are my margin dollars? And are my margin dollars higher than my expenses? If not, I need to diagnose this. I need to understand whether the problem is in my margin or potentially in my expenses, or both. Margin can be complex to unwrap, but that exercise and the time you spend on it is important to be laser focused on. As you think about which margin relationship to track, I want you to think about what is most important to your business. I'll use this example of filling up a jar of rocks, gravel, and sand. It all needs to go in, but in what order matters greatly. The lift for each is different, so where do you spend your time and your energy? First, ask yourself what represents the largest portion of your business revenue and margin. Those are really the big rocks of your financial plan and should be the largest portion of your analysis time. You need to be dialed in understanding the plan and results of those big rocks first. They go in the jar first. You don't want to spend all your time and analysis on the smallest category of the business while the largest category is considerably unprofitable. Every dollar matters, but the effort to achieve each dollar may not really balance out. If you start with sand and gravel first, you actually may not be able to fit the big rocks in the jar. So start with the biggest chunks. Coincidentally, they often also carry the largest financial planning and investment. For some of you, these big rocks are going to be bike revenue, then service revenue, then accessories revenue. For others, it might be service first, then accessories, then bikes. The point being, spend extra time on the category that is most important for your business and less time on the category that is just the filler. Of course, we want to maximize all of them, but care and attention to your primary driver is critical to your ultimate financial success. Okay, so I'm telling you that I need you to analyze your margin performance and focus on the most important areas of your business first. What does that mean? How do I actually do it? First, I'm going to gather the results for my business, and in this case, I'm going to use the data from the Cost of Doing Business survey from the NBDA as a comparison. This is where I really like the way that the NBDA data is laid out in their Cost of Doing Business survey. It provides perspective that I can compare my own results to as a shop with a bit of context based on a full sample size of all shops, but also based on shops in areas that are similar to mine. So in this case, based on city size. Okay, so once I have my data organized, I'm going to start asking myself some really hard questions. We're going to use bike margin as our example here. First up, I like to get big picture perspective. What are my top bike brand relationships, and what are the categories of those brands that I'm selling? Next up, again, developing this a little bit further. How are they performing? What are the winners? What are the losers? How does my realized margin compare to what my planned margin actually was? How does this compare to our results last month, last quarter, and potentially last year? Now, why? What are those leading factors for my results? Is this about product assortment? Is this about pricing? Is this about competition in the area? Get really clear on why you believe your results are the way that they are. Finally, what am I going to do about it? What is my strategy to exploit those areas where I am strong and improve those areas where I am weak? You will notice that these questions are both quantitative and qualitative in nature. What we sell and for what amount is influenced by how we buy and how we sell. So employ this methodology to all the important parts of your business as you assess margin. Spend extra time on the larger categories to maximize your investment and analysis time. Moving on to selling, general, and administrative expenses, also known as SG&As, and back to our full income statement view. Again, notice the common sizing viewing each line as a percentage of revenue. I've also brought in some industry average from a previous NBDA report on the right-hand side. I like to be very deliberate about how I look at expenses. Again, think about those big rocks first. Review the largest expenses all the way down to the smallest expenses in that order as your starting point. Try to understand what is fixed and what is variable. This is a good test to understand those items that are tied a little bit more closely to revenue, like credit card fees, versus those that are not going to change very much, like our rent or occupancy expense. Look at your expenses with a critical view. And I like to think that attitude helps a little bit here as well. Really think about what is the benefit of this expense? Why are we spending the money? And does it help us create a return for the business or for the owner of the business? Finally, with net income, this is gross margin less SG&As, less other income and expenses like interest expense. That equals our net income before tax. Chop off 30% and you have your take-home pay at the end of the day for the business. Another comparison point within the income statement is known as EBITDA, which is our earnings before interest, taxes, depreciation, and amortization. EBITDA helps us wade through the noise of the net income statement and understand the true operational efficiency of the business. It helps us answer that question, is the core business model working? Now we're going to move into the next key financial statement, which is the balance sheet. So what is the balance sheet? The balance sheet is that ledger that tells you the net worth of the business. It looks at your assets, your liabilities, and your shareholder or stockholder equity. While the income statement can view your results over a given period of time, like a month, quarter, or year, the balance sheet view is just a single moment in time. Our balance sheet is going to look at the assets of the business, the liabilities, and the equity. Back to the analogy of the house. Consider the purchase of a house with a loan. The house and its value is our asset. The mortgage is the liability. The difference between those two is our equity. The basic calculation of the balance sheet is assets being equal to liabilities and stockholders' equity. Notice on the right-hand side that we are also back to a form of common sizing similar to the income statement. But with the balance sheet percentages, we are more specific within our percentage comparisons. We are tying each asset class to total assets, and we are tying each liability class and equity classification to total liabilities and stockholders' equity. The common sizing nature continues to be important, but just has a slightly different structure for you to be aware of. As we assess our balance sheet, we are going to focus on two main sections, assets and liabilities. Within both assets and liabilities, we have short-term or current and long-term or fixed categories. First up is a review of the structure within assets. We have a few items within current assets that are important to understand. Specifically for retail operations, we are likely to have just cash and inventory as the primary drivers of our current assets. Cash and cash equivalents are exactly what they sound like. Cash in a bank account or cash equivalents that are easily converted into cash. We also have inventory, which is typically going to be the largest current asset for a retail business. Additionally, we have long-term assets. These are typically going to be buildings, equipment, and any other assets that we might have capitalized with a useful life that is greater than 12 months. Again, a similar view with liabilities, short-term or current, and long-term or maturities that are greater than 1 year. Current liabilities are typically going to be dominated by short-term financing instruments like credit cards and bank lines of credit, along with their accounts payable invoices. We also may have the current portion of our long-term debt due within the next 12 months. Our long-term liabilities are liabilities that have future maturities beyond 12 months. These might be the SBA loan that we use to fund the business or our business vehicle that is on a 5-year note. Now, as we think about assessment of ratios within the balance sheet, we do have the ability to create ratios within the balance sheet to help us better understand what is happening. With the income statement, we are using percentages as some of the financial measurement ratios. Think about gross margin as a percentage of revenue as the ratio that we are reviewing. But for the balance sheet, we're getting a little bit deeper into ratio calculations to help better understand what is happening. We focus on liquidity along with two other common ratios for return on equity and return on assets. There are, of course, many different ratios that we can use and access. While these are important ratios to start with, you may find that your situation or your ownership structure may require a different set of ratios. As with the income statement, ultimately, you need to determine what is most important for you to be able to clearly assess the health and the performance of your business. So let's start with liquidity. At the highest level, liquidity ratios are meant to provide us an understanding of our ability to meet our short-term or current liabilities with our current assets. Think about this from the perspective of having the necessary cash to make payments on accounts payable or interest payments or our credit card bill. How much flexibility do we have within our assets? We can get a better understanding of this by reviewing two similar but slightly different ratios. First up is the current ratio. This is likely what your bank cares about when establishing covenants or rules for a line of credit agreement. This is the most common view of liquidity. The basic calculation is dividing current assets by our current liabilities. If my current assets are $200,000 and my current liabilities are $100,000, my ratio is 2. Ideally, we want to stay north of 1.5. Anything below 1 is a concern given the nature of inventory valuations over the long term. The second ratio is the quick ratio. You might also hear this known as the acid test ratio. Very similar to the current ratio, but we're removing inventory from our current assets. Ultimately, this is a measure of cash in the business and the comparison of that cash balance to our current liabilities. Because inventory is such a huge part of retail operations, it is very common to see a quick ratio below 0.5. A ratio of 1 is a really good target to keep in mind. These other two ratios from the balance sheet are important to be aware of as well. Return on equity is what investors in your business are likely most interested in. It helps answer the question of how profitable their investment or their equity is in the business. As an investor, we can use this ratio to compare across different investment opportunities. We can compare this to the industry average around 18%, to the stock market S&P 500 long-term average of 14%, or potentially years past in our own business. We want to be north of 10% on a consistent basis, but ideally we want to be a little bit closer to 15%. Return on assets is another useful balance sheet ratio that helps us understand how well our assets are performing. We are going to review our assets against our profitability. So now we are combining income statement information with balance sheet information. 5.5% is a great benchmark for us, but the ideal benchmark is against your own previous results and continuing to increase. Similar to return on equity, the NBDA also calculates this in their own cost of doing business report, but refers to it as net profit before tax to total assets. So if I had to boil this presentation down to a cheat sheet of what ratios you need to know and understand, this would be the list. On the income statement side, are we growing revenue or declining revenue? By what percent and what dollar? Next up, are we improving margin or declining in margin? Again, by what percent and what dollar? Next up is, are we spending more in expenses than we are making in margin? What are expenses as a dollar and as a percentage of sales with a key focus on areas of payroll, occupancy, and any variable expenses that can see greater impact from inflation, things like credit card fees or freight if your product sales require shipping product. Finally, net income. Again, are we making money? Why or why not? On the balance sheet side, we want to have an understanding of the trends we are showing in liquidity as identified by both the current and quick ratio. Do we have a concern on our ability to meet our short-term obligations with the current assets we have on hand? Why or why not? What are the drivers? The cash flow, which we did not discuss in this presentation, is also a great indicator of how cash is moving in and out of our business on a monthly basis. Liquidity continues to be incredibly important to appropriately run a business and, quite honestly, to be able to sleep at night knowing that we've got the cash on hand or the assets on hand to pay for our short-term obligations. Finally, return on equity and return on assets help us understand the investor view into our business and the efficiency of our assets. Finally, I want to remind you of the theme for Frostbike here in 2026. That theme is take the lane. For me, this means being active, not passive in your business. Financial statements can be awfully intimidating. Don't forget that you are not alone in this. There is a tremendous amount of information to learn, and we all get overwhelmed. My advice is to break down the topics. Take your time building that foundation. Make sure you understand what you're talking about by learning one area of the statements each month and then move on to the next area. Get to that point of being able to expertly explain these concepts to anyone. Be the expert on your business in all areas, not just the areas that you are strong in. Build your foundation consistently and always remember to take the lane. As we wrap up the presentation, I hope that we have achieved our purpose of building your awareness, your understanding, and knowledge of the components of financial statements, and an introduction to financial analysis. Myself and my team are available to you if you have questions, ideas, or need to bounce your ideas off of someone outside of your business. And we authentically mean that. There are times as a business owner where you may feel like you are on an island and desperately need someone to chat with you. Maybe it is an idea, maybe it is a financial question, maybe you just need someone to confirm what you understand to be true. We are at your disposal and happy to help. The NBDA's P2 program is also a fantastic resource to engage with a peer group while also continuing to engage in formal education. So thank you for attending this presentation and supporting Frostbike now and into the future. Best of luck to you and your teams throughout this year.